Good to see you. Happy Tuesday. We just came back from SmartCon NYC last week, Chainlink's institutional event. It was absolutely stellar. I mean, so much is happening with regards to tokenization, with regards to stablecoins. The perception has flipped entirely on DeFi. Obviously, privacy is a big talk of the town now. A lot of things to jump into, but guys, I would love to just get a quick brief about yourselves and kind of what each of your projects are for the audience. And then let's jump into it. So Nils, maybe you can kick us off.
Yeah, sure. I'm Nils, co-founder of Vesu. We are Starknet's main lending market, where people are able to borrow with their Bitcoin as collateral or other assets as collateral, earn yield, and all of that in a fully non-custodial way. I'm been in the space since 2017, and I'm really excited these days about the ability to build products that look a lot like neobanks, a
Oh
lot
yeah.
like Web2. The UX that we are able to deliver today is so much different and so much better from going back to 2017 again, and that's very exciting.
Beautiful. Welcome on. Arpan.
So I'm the founder of Noon. We are building the highest yielding, safest, and most rewarding stablecoin in crypto. My background started off my career at a management consulting firm called McKinsey, spent some time at Goldman, built a neobank in the UK. So understand a lot of the trials and tribulations from that space, but also understand a lot of the institutional demand and the guardrails that we need to put in place in order to make this space as safe and attractive for not just people in crypto right now, but for the next billion plus users. So yeah, super excited to get into it. Super excited to speak to you guys about what we're building with Nils on Starknet.
Yeah, awesome guys. So before we jump into some of like the nitty gritty of the yields and kind of the mechanism design, just kind of holistically, we've seen a lot of regulatory landscape evolution the last 6 to 9 months, really since Trump got into office. But feels like the last 6 months it's really picked up in a positive way. I had the CEO of the Digital Chamber of Commerce in DC on the show last week. He's optimistic about the market structure and the Clarity Act. The market structure bill being passed before the next Congress, which is December of next year. So not as fast as many of us would have liked, but the Clarity Act seemingly has been started to move forward. We've been in this government shutdown as well for almost 2 months now. It's been absolutely unreal. So not much has been getting done, I don't think, but I think when that reopens, we should see an ushering of new ETFs and just further progress on the Clarity Act and the market structure bill. So from the perspectives of building neobanks, of building DeFi products, how do you guys position or think about the evolution of this space? Let's call it over the next year, right? So we are kind of entering. I'm viewing this year as like a line in the sand type of year, meaning that that the space is quite different going forward. For each of your product designs, for your users, for your thought process about implementation, distribution, it's quite an open-ended question here. But generally, how do you think about the industry evolving, and then how does that affect your decision making as the founders of your respective companies? And Arpan, please.
It's a really good question. It's a question that we think about a lot. I think right now you've had a couple of big stablecoin regulations come out, MiCA in the UK, in the EU, Genius in the US, and both of these are pretty conservative when it comes to sort of what are permitted regulated stablecoins. They only really allow stablecoins to be very low yielding, invest in sort of the most liquid of liquid assets, right? And I understand why this is happening. Obviously, they want to walk before they run, and they want to take as conservative and as safe of an approach as possible. But frankly, that kind of restriction is even more restrictive than the HQLA requirements imposed on mainstream banks by Basel III, right? So I'm a firm believer that that is a stepping stone while the regulators figure out the true risks behind stablecoins to a future which is probably going to be a little bit more flexible and free. And so with that in mind, we are building a stablecoin not with regulators in mind, but with the end customer in mind. And we will basically adapt the jurisdictions that we actually go out and distribute the stablecoin based on what the regulator does. So right now, we're not planning on any distributions in Europe. We're not planning on any distribution in the US, because frankly, that just restricts our product too much to an APY, which is basically the T-bill rate, right? Which is 3-4% right now, where our competitors are at 7 or 8%, and we're at 15%. So that's the only way that we feel that we can really be successful.
Nils.
Yeah, I cannot speak to stablecoin regulation as much as Arpan can, of course. And I think we've really seen a lot of good progress on the regulation side. And I think mostly in the sense that regulators and the broader industry starts to take an interest in this industry, right? I think that in general is a very positive development, right? Which actually shows where we have gotten to something that it's worth paying attention to. There have been different reasons, of course, why over time regulators started to look at certain things. The Celsius and all of these incidents, right? But overall, what I really like about this development is that the industry itself is maturing, right? And regulations can, of course, hinder your product development. I mean, ultimately, what we all want to be is kind of an internet native product. What I always still think is mind-blowing is just on a technological level, we can build a product that we can distribute very easily to any part of the world, wherever the internet goes to, right? And I think this is one of the properties, if you think in terms of a product, that we try to preserve, right? So of course, there are developments also on that side which we are very cautious about and observing. In terms of specific regulation, some of the things that is just a line for us that we don't cross are the obvious functions from traditional markets that we don't want to tap into, right? So something like custody. It's a line, we never touch user funds. We design the lending market in a way where we do not control funds. We don't have control over user funds and stuff. So let's say, some of the obvious things that we can make right now, we are very careful to not cross those lines. And for those things where we still don't have enough clarity of what's possible kind of in this new world and in this new environment, I think it's to a certain extent like the entire industry. We are watching, observing, and learning every day where the industry kind of heads into. I think we will see much more kind of influence from regulators and the traditional industry as the traditional financial industry starts to take a bigger interest in DeFi, let's say. And so we are observing that a lot.
Yeah, I mean, I think the traditional industry wants to get some sort of access, right? So we saw these digital asset treasury companies. Some of them have started to use Ethereum DeFi. ETHZilla deposited a bunch into Puffer, like a restaking product. SharpLink has deposited a ton into EtherFi's cash product. And so like we're definitely seeing this institutional demand for basically just yield on ETH. But I think Bitcoin is like the next big frontier. So Ellie, the co-creator of Starkware and Starknet, he's got this saying that kind of like Bitcoin used to be this kind of dead under a rock type of asset, but now it's moving away from just being a store of value. I think Starknet has just recently launched a BTCFi campaign. Obviously, you guys are both, bringing USN and sUSN on your side, Arpan on Starknet. Nils obviously have been doing, have had your exchange there and your product there for some time. Maybe we can just walk through this. What is this BTCFi campaign, Nils? And what does Starknet and Vesu help Bitcoiners do with their Bitcoin? How do you help them get yield? What does that kind of look like?
Yeah, sure. I'm very happy to go into that. Look, BTCFi has one goal for us, for Starknet, for the entire ecosystem. It's to bring more utility to Bitcoin. It's to allow Bitcoin holders to do more with their Bitcoin than just holding it in cold storage and selling from time to time when they have to pay their bills or want to renovate their homes or send their kids to school, right? Bitcoin, I think we all agree, is the highest, quality, highest reputation crypto asset that exists, and it should receive that treatment in terms of being able to use it as collateral to take a loan instead of having to sell your Bitcoin, or to earn interest on it, earn yield on it, and save Bitcoin. So this is the very, objective of BTCFi on Starknet. And there are a bunch of things that Starknet as an ecosystem does to do that. It's not a traditional, let's say, incentive campaign where, we just throw some rewards on users to deposit their Bitcoin assets. It's a really well thought through strategy behind it that has multiple levels. And I think that's something that people need to start to explore. I just want to highlight a few things which are really different from this BTCFi campaign. It starts with securing Starknet itself as a chain with Bitcoin assets. It's on the one hand the low risk kind of yield source that you can get, similar to staking Ethereum, right? And on the other hand, it's an alignment with Bitcoin as the asset and Bitcoin the community. So you can now stake Bitcoin to secure Starknet and earn staking rewards, or staking yield on your Bitcoin. There are LSTs, so similar to Wrap Staked ETH. There are now LSTs on Bitcoin on Starknet. You can use those LSTs to borrow against them. You can use Bitcoin assets to take USDC loans. You can earn yield on your Bitcoin. Everything that Starknet and the ecosystem, the apps do, focuses on bringing more utility to Bitcoin and give Bitcoin the quality that it should have as an asset that we can use in all sorts of transactions in DeFi.
Yeah. Arpan, I must say, one of my big regrets is not holding on to Bitcoin in 2017 when I first found it. I had a couple $1,000s to my name. I had a couple Bitcoin. And what I should have done back then is find a product that allows me to borrow against it, some solid stable coin, get some yield, hold on to it, keep borrowing against it as the price appreciates, pay for my lifestyle. From your perspective with USN, sUSN, in collaboration with Nils here and Vesu, or just generally, how do you think about the users for the stablecoin? How do you think about kind of the demand for kind of like Bitcoin backed loans when it comes to who's going to be using and what are they going to be using your stablecoin for from Noon? How do you think about that customer segment? You mentioned not in the States, not in Europe. Kind of what is the holistic viewpoint here for types of use cases, types of users, and generally where you expect or where you have been seeing the most traction?
Yeah, honestly, it's kind of exactly as you say, right? I think I've heard this story so many times with people who got into Bitcoin from like 2013 to 2017, even 2019. And a lot of people didn't really know that Bitcoin would become this kind of like inflation proof store of value that it's become today, and obviously skyrocket. If you knew that, obviously you'd be like a multi-millionaire by now, right? Um, and as a result, more and more people, and this is when I say people, I mean users, both retail and institutions, are thinking and saying, okay, we need to have Bitcoin on our balance sheet, right? Be it our personal balance sheet or our corporate balance sheet or our fund balance sheet. Now, obviously, there's going to be some volatility, there's going to be some appreciation, there's going to be some depreciation. We're okay with that, but how do we maximize the yield? How do we sort of squeeze as much juice out of Bitcoin as we can without giving up on that upside without giving up on that inflation hedge, right? And unfortunately, as I think everyone knows about Bitcoin, there isn't very much native yield, right? Native yield on Bitcoin is something between 1% and 3%. That's why I think when Starknet came to develop their BTCFi campaign, they approached us and said, hey, listen, we need real native sources of yield that are going to allow people using Bitcoin to use the Bitcoin as collateral, borrow a non-yield bearing stable like USDC against it, and then deposit into a yield bearing stable. And what better yield bearing stable than something that is safe, highly rewarding, and extremely sort of competitive against every other stablecoin out there right now. So that's what we're going to start with. And we're going to focus on first bringing on, I think, some major institutions. Then we're going to start opening this up to your day-to-day retail user and allow people to keep a hold of Bitcoin, keep that value appreciation going, while at the same time generating really safe delta neutral yield against it.
We all love yield.
You know what? I love safe yields. And I think that especially, I'm sure everyone has seen over the last week or two, the distinction, even within the stablecoin space, between safe yields and yields in general. So that's why whenever we talk about Noon, we always distinguish between, we're not always going to be the highest yielding stablecoin full stop, but we're going to be the highest yielding safe stablecoin. And we do that through a variety of risk management. So low risk to us means, I mean, we can spend like 3 hours just talking about that, right? But to us, what low risk means is so the way that we work is we deploy a bunch of deployment strategies across DeFi, CeFi, and TradFi. So we go to wherever the lowest risk, highest yielding yields are. But so that gives us a massive universe to play around with. But what we need to do then within that universe is look at each yield strategy and do a very detailed risk assessment on this. And this is when my team's background in traditional finance and banking, risk management, investment banking, et cetera, all come in handy. So for each and every yield source, we have a detailed risk assessment that takes into account, your typical risks, your market risk, your liquidity risk, your smart contract risk, your volatility risk, et cetera, et cetera, et cetera. We publish it to everyone. We let our community discuss it. We let our community vote on it. And only then do we actually allow our deployment strategies to encompass these new real yield
Yeah, I
sources.
mean, I think that the definition and the terminology sometimes is hard to get in alignment of, but Vitalik has been pushing this low risk DeFi. Like he's like, I love high risk DeFi. I love, the poly markets or whatever it is, but low risk DeFi. So when it comes to the actual yield opportunities for both of your protocols today, I think transparency is what people want. They want to see that transparency of the yield. They want to know what they're getting. How do you guys provide transparency to your users? What does that look like when it comes to Bitcoin yields, when it comes to stablecoin yields? Yeah, Nils, maybe you can try that one.
Yeah, so Vesu is a DeFi lending market, right? So it's built on the Starknet chain. Everything's fully transparent by design, right? In the sense that it runs by smart contracts. Everyone can see at any time where the fund's at, that no one is just taking out funds that shouldn't, or that even no one can, right? Because everyone can verify permissions. Now, this is the nature of DeFi, and while all of this is available, it's actually also not, because a regular user cannot go and go through contracts on chain, or even use a block explorer. So what's really important there is to have the tools that users can actually make use of that transparency that we can provide them, right? And so how that looks for us is, first of all, on the Vesu UI, where you ultimately make your decisions, decisions where you access yield, where you deposit funds into. We provide already very important information, including what collateral exposures, for instance, you have if you deposit into that market, right? So just the really necessary information for a professional user to make their decision about the risk that someone's exposed to. And this covers most things that most people need to understand before they make a decision, right? But then there is more information that you or some people actually use to verify things, and so an important tool that DeFi and crypto has is Dune dashboards, right? Which is also, if you think about it, and if we come back to kind of the traditional neobanks, is something that's really, again, a very feature of DeFi. Anyone builds a dashboard and actually verifies and makes sure that what they actually claim, where you're depositing into, it's actually exactly that, right? So, a Dune dashboard where if you need to understand more, you can go and verify. But then also, just I think transparency to understand the data is one important thing that is characteristic of DeFi. But the other thing is actually other safety mechanisms, like there is a Vesu UI, I want to deposit and I want to be sure I can always withdraw again, right? Now, what happens if this UI is actually down? It didn't really happen. We have a really good uptime for the Vesu UI, but still it can happen anytime, right? We have seen infrastructure failures like, Amazon, which was down. So yeah, it can happen. And so what I include in this transparency conversation is also the tools necessary to access my funds if, for instance, the main UI is down, right? So there is a fallback UI where I can get access to my funds if the main UI is down. And so I think what's really important is when you talk about transparency is, yes, by design, we can create transparency, but we need to provide the tools that users actually can make use of this transparency and the data.
Yeah. And then Arpan, when you're collaborating with teams like Akubo, like Vesu, others, it's obviously important for you to understand what's happening and have that transparency, but also vice versa into your protocol and into, the design that you guys have. Talk to us about some of the collaborations that have been going on, how those have been going, kind of what each of the pieces of the Starknet kind of DeFi ecosystem enable for you guys from Noon's perspective.
Yeah, for sure. I think first on transparency. So we've actually been beating the drum on transparency and security probably for longer than anyone else.
That's good.
And so I believe we're the first stablecoin to have a independent live proof of solvency, which our partners at Accountable, we partnered with them probably 6 to 9 months ago. And effectively, what we did with transparency, we said, all right, everyone has these attestations, right? Where they're like, okay, cool, we have all the money you think we have. But most of that is just self-reported data. And frankly, I can come up with a website that tells you I have $20 million. If you think I have $20 million, that's not very hard. So rather what we did was we worked with our partners at Accountable and we said, okay, let's have a third party come in. Let's connect them directly to our custodians and our custodial partners and let these two parties directly contact each other, right? Without us in the middle. So we have no ability to influence the data. We're not giving the users the data. They are directly getting the data from the people who hold our assets. And then they're publishing it live, real time, every 15 minutes. So our users can literally go on our proof of solvency website, noon.accountable.capital right now, and on a real-time basis see exactly what our reserve position is, what our supply position is, so if we're over collateralized or under collateralized, and exactly how our reserves are deployed. So what's our current deployment mix? How's that changing over time, etc. And I think that is the ultimate level of transparency that this industry needs, and I think a lot more people need to start embracing.
I mean, I completely agree. I mean, we've kind of bucketed now yield-bearing stablecoins and Genius-compliant stablecoins almost, and like the Genius-compliant are basically impossible to fail. Knock on wood. And then the yield-bearing ones have a bit more leeway. Did you guys watch what unfolded with Stream and XUSD and these vaults and the drama between Gauntlet and Chaos Labs and Aave and Morpho and all this over the last week or so? Did you guys?
Yeah, very closely.
Okay, so Arpan, from your perspective, like, what went wrong, or what can we take away from that going forward as a community, as far as implementation details for stablecoins and vaults?
I mean, so the Stream and DUSD situation in particular was I think the TLDR is don't take shortcuts to growing TVL, right? Which is exactly what they did. They basically said, hey, listen, we're gonna, again, in a much more complicated way, we're gonna give you money, you guys give us money back, and we'll just kind of loop it around and grow both of our TVLs really, really fast, right? And what that created was effectively the same dollar was underpinning $5 to $10 of each of Stream and Elixir's TVL, right? We decided from a very, very early point in time. So we've been approached by several protocols, and I mean, Stream and Elixir by no means were the only ones going out there looking for these kinds of deals. We were approached by several of them, and we actually, I think, posted a screenshot of us, again, 3 months ago, declining this, saying there's no way we would ever consider something like this because it just erodes the quality of our reserves. So I think that's the big TLDR for Stream and Elixir is for stablecoin protocols, don't try to take shortcuts because at some point it will catch up to you, right?
I mean, just the over rehypothecation for no reason other than just greed and yield and whatever. I mean, we saw this so many times in DeFi. That's like always what the issue has been, is the over rehypothecation of funds.
If I may, I think there's a very important distinction to be made here between rehypothecation and recursive lending, right? So rehypothecation, I think, is totally fine as long as you're not kind of doing this incestuous recursive lending. So that's the rule that we strongly adhere to, that if we, for example, we have DeFi deployments within our deployment stack, right? We will never, ever deploy into any DeFi protocol that it deploys into us. So we've had lots of conversations with large funds, curators, et cetera. And we've been very, very clear about that if we deploy into you, you can't deploy back into us. And vice versa. If you're deploying into us, we will never deploy into you. But otherwise, I think rehypothecation, frankly, is one of the superpowers that DeFi has and one of the advantages that DeFi has over TradFi, because of two things, right? One, DeFi is super transparent. I can see exactly what's backing my loan no matter what. And this is exactly what Nils was talking about, right? And then second, you have smart contracts. We can actually automatically liquidate, automatically unwind positions the moment certain thresholds get met. I think rehypothecation is a massive advantage that DeFi has over TradFi because you can't get that level of transparency and that level of automation in TradFi. So rehypothecation, I think, is fine. Recursive lending, where you're kind of incestuously looping between two protocols just for the sake of kind of nebulous TVL that really doesn't exist, that was the problem, and that's what we need to avoid.
Nils, anything from your side on that?
Yeah, I completely agree with the point that Arpan made around don't take shortcuts to boost your TVL. I think that is a big reason why these things happen and why they happen again and again, right? In DeFi. And so, just one comment from how things have been done. BTCFi, there was a program before BTCFi, and Starknet was always very, very it was very important for them to actually not reward, for instance, recursive borrowing and lending, right? And it's for exactly that reason. Starknet, the team, we at Vesu, we don't build to just create the bubble that may explode like in 1 or 2 months, but we had, our stats looking nice for that time. Everyone builds for the long term, and I think that's what's really important, and that what helps, the ecosystem to stay secure. Then the other part of my reaction would be, it's also from the perspective as a lending market, and in particular, Vesu being a lending market that works similar to more for Euler, where third-party curators actually curate pools and vaults. One thing that we are really watching closely is how well can, let's say, the infrastructure provider like Morpho or like Euler kind of shield themselves from like the impact that this can have on lending markets, right? Even though third-party curators actually operate those pools, and I think that's something that we are very interested in. I think it goes back to a governance level, even in that curator-based lending model, which I personally still think is the model that will succeed in the long term. There is governance going on, right? And even if it's just the governance around what do you actually show your users on your website, right? And that's very important because you want to protect your users and you want to protect your brand, right? And so I think it ultimately goes back to having different parties doing different things in this whole transaction. Who does governance? Are they the same people that actually then benefit kind of economically from such behavior? And I think that's where we will see the industry mature. We'll see it to be more professional. And I think for lending markets, it's really important to make sure users are safe and protect your brand.
If you guys got another minute, I'm super curious to understand your takes on the Uniswap proposal for the Uni token. Did you guys see that?
I did not,
Okay,
I
so
have to say.
Okay, so basically what's happened is that Uniswap has been under fire by the crypto community for so long for basically having the labs make all the money, 9 figs in revenue a year, and the token holders effectively have no claims on any revenues. They charge that small front end fee now, goes to the labs. They have that 0.3% LP fee, goes to the LPs. And so there's really like no way for the token to be represented as part of this. It's like, why would you even have a token, right? But Hayden and the team just came out and said, basically, we're going to be distributing cash flow back to the token, and like we're going to solve this equity token holder kind of dysmorphia problem. Hyperliquid is notably led the market this year with this model. Obviously, not everyone's going to be able to make as much as they make. Perps are hot. Starknet has had staking. They've kind of started to think more deeply about this. ZK Sync had just put out a whole ZK token model thing that they're working on, a proposal. It very much seems like the regulation has opened up for what would previously have kind of go into the semantics of what these things are. What's your take on this trend, guys? Do you think that this continues, accelerates, decelerates? How do you see crypto asset mechanisms being kind of evolving through this better era of regulatory clarity? Plus, I had this saying, return to fundamentals. It's just like, let's do the basics and bring value back to the shareholders. Kind of what is your high level view on this trend?
Yeah,
Well,
I'm
I think
happy.
it's a really important topic if you start to think about issuing a token, right? I think Uniswap, but also a lot of the blue chip assets which have launched way back, and which have been launched around narratives mostly. I think we have seen the industry to move into a more kind of fundamentals based approach. I think both is still possible. There are assets, tokens that run purely on narratives, which is fine. I think for DeFi protocols, you are by nature more under scrutiny because you're actually generating fundamentals. And so I think it's totally expected that people will want to have some of that, and that your valuation somehow is rooted in that. So on Vesu, we did not launch a token. Vesu doesn't have a token. There is no token. There is no VCs actually who have tokens and stuff. So what we wanted to make sure is we need to have a product that can generate fundamentals at some point. We need to have product market fit before we even want to think about what the role of a token would be, right? And I think this is really different nowadays than it was 4 years ago, 5 years ago, and there are various reasons. So I'm not pointing fingers at how things have been done back then versus now, but I can totally understand the industry changes, and people look at fundamentals now.
Thank God, eh? Arpan, close us out, man.
Yeah, so agree with everything Nils has said, and I'll give you a very sort of real example. So when we started Noon, we knew that we wanted to make sure that our governance token holders, first and foremost, governed our protocol, right? That was super important to us. And as a result, we actually said, hey, listen, let's not take in any external funding. Let's not give out any tokens to VCs, early LPs, or like a small group of individuals who are going to be able to dictate what our protocol does in the future. Let's truly make this a democratized, user-controlled protocol, right? And as a result, if we put this much of an emphasis on users governing, we need to make sure that they get something else out of the governance token other than just governance votes, right? And I think, as Nils said, right, I think in 2021, 2022, you could get away with saying, hey, listen, we'll figure out actual dollar utility later on, partially because of how conservative the US was being, but partially just because the market was okay with it, right? VCs were fine pumping money in, retail was fine pumping money in. But now, so from day one, we always said, hey, listen, we're always going to have a way to get dollar value back to our governance token holders. We were, I believe, the first stablecoin to implement that. Our governance token is going to become transferable in January of 2026. And we'll see that coming to life, which will be really, really exciting. And to your question, I think that needs to become the norm, right? I think you're seeing very, very evidently that the public and the markets are valuing pure governance value at a marginal premium. And unless there's actual like cash flow and NPV going back into the governance token, valuations are just going to crater. So I
Totally
think the
agree.
market's spoken.
Or you're just going to buy hype, or you're just going to buy whatever, because why would you
Exactly.
not own the thing that actually you can sleep at night? We got a guy in the chat, Bosco, saying when Vesu. I think it's probably a good time to wrap out. I think we're getting the when token question now. So that means that it's been a good conversation, lads. Appreciate your time. Appreciate your work on Starknet, and look forward to following along with what you guys are building.
Awesome.
Thanks for your time, Andy. Appreciate it.